I need to warn you about something that could devastate your portfolio in the coming months, something that most investors are completely ignoring, something that the financial media is not talking about because they do not understand the forces at work. There is a crash coming in the real estate investment trust market, the REIT market, and it could begin this quarter, not next year, not sometime in the distant future, this quarter. The conditions are in place. The dominoes are lined up. And when the first one falls, it will trigger a cascade that will destroy billions of dollars in investor wealth. I have been investing for over 70 years. I have seen real estate booms and busts. I have watched supposedly safe income investments collapse when conditions changed. And I am telling you right now that the REIT market is more vulnerable than it has been at any point in my lifetime. Most investors own REITs because they want income. They want those fat dividend yields of 5, 6, 7% or more. They want the stability that real estate supposedly provides. They believe that physical property, bricks and mortar, office buildings and shopping centers and apartment complexes, these things cannot lose value the way stocks can. They are wrong. Real estate can lose value, REITs can crash, and the conditions for exactly that kind of crash are present right now. Let me tell you what I am seeing. Let me explain why this crash is coming. And let me show you which types of REITs are most vulnerable so you can protect yourself before it is too late. The REIT market is facing a perfect storm of negative forces. Any one of these forces alone would be concerning. Together, they create conditions for a crash that could rival 2008 in certain sectors. The first force is interest rates. REITs are extraordinarily sensitive to interest rates, more sensitive than almost any other asset class. When interest rates rise, REIT prices fall. This happens for multiple reasons that compound each other. REITs borrow heavily to finance their property acquisitions. A typical REIT might have debt equal to 40 or 50% of its property value. Some have even more. When interest rates rise, the cost of servicing that debt increases dramatically. A REIT that was borrowing at 3% is now refinancing at 7%. That difference comes straight out of the cash available for dividends. Let me put this in concrete terms. Imagine a REIT that owns $1 billion of property with $500 million of debt. At 3% interest, the annual interest expense is $15 million. At 7% interest, it is $35 million. That is an additional $20 million per year going to lenders instead of shareholders. For many REITs, this difference is larger than their entire dividend payment. They simply cannot sustain their dividends after refinancing at current rates. Something has to give, and that something will be the dividend. At the same time, higher interest rates make REIT dividends less attractive relative to alternatives. When Treasury bonds yield 5% with no risk, why would you accept 6% from a REIT with substantial risk? Investors demand higher yields from REITs to compensate, which means lower prices. This relationship is mathematical. If a REIT pays $2 per share in dividends and investors previously accepted a 4% yield, the stock would trade at $50. If investors now demand a 6% yield because treasuries are more attractive, the stock falls to $33. That is a 34% decline with no change in the underlying business. We have seen exactly this dynamic play out since 2022. REIT prices have fallen substantially simply because investors are repricing them relative to higher interest rates. This repricing is not complete, and higher interest rates reduce the value of the underlying properties. Real estate is valued based on the income it generates and the rate at which that income is capitalized. When capitalization rates rise with interest rates, property values fall even if the rental income stays the same. Let me explain capitalization rates because this is crucial to understanding property values. The cap rate is the ratio of net operating income to property value. If a property generates $10 million in net operating income and is valued at $200 million, the cap rate is 5%.
During the low interest rate era, cap rates compressed to historically low levels. Properties traded at cap rates of 4% or even lower. Investors accepted low yields because the alternatives yielded even less.
Now cap rates are expanding. A property that would have traded at a 4% cap rate meaning $250 million for that same $10 million in income, now trades at a 6% cap rate, meaning $167 million. That is a 33% decline in property value with no change in the income. This cap rate expansion is happening across the REIT sector. But it is being hidden by the way REITs report their financials. Most REITs use appraisals to value their properties, and those appraisals often lag reality. The stated net asset values do not reflect what properties would actually sell for today. We have already seen this play out. From early 2022 to today, the REIT index has declined substantially. But I am telling you that this decline is not over. It is not even close to over. The full impact of higher interest rates has not yet hit the REIT market. Here's why. Many REITs locked in low interest rates during the pandemic era. They borrowed at 3% or less with maturities of 5 or 7 or 10 years. Those loans are now starting to come due. Over the next 2 years, hundreds of billions of dollars in REIT debt will need to be refinanced at current rates. I have studied the debt maturity schedules of the major REITs. What I see is alarming. Many REITs have 30, 40, even 50% of their debt maturing in the next 24 months. They will be forced to refinance at rates more than double what they were paying. The impact on cash flow will be severe. When a REIT refinances debt from 3% to 7%, the impact on cash flow is devastating. Interest expense more than doubles. The money that was going to dividends now goes to lenders. Either dividends get cut or the REIT has to sell properties, or both. Selling properties in this environment is extremely difficult. Buyers are scarce because financing is expensive and values are uncertain. When REITs do sell, they often receive prices far below their carrying values. This forces them to recognize impairments and reduces their equity base. This refinancing wave is about to hit. It could start this quarter. And when it does, REIT prices will fall much further than they already have. The second force is the fundamental deterioration in several major property sectors. This is not a cyclical downturn that will reverse when the economy improves. This is structural change that is permanently impairing the value of certain types of real estate. Office buildings are the most obvious example. The work-from-home revolution has permanently reduced demand for office space. Companies that used to lease 100,000 square feet now lease 60,000. Companies that used to require all employees in the office 5 days a week now allow hybrid work. Some companies have gone fully remote and eliminated their office footprint entirely. This is not going to reverse. The pandemic proved that knowledge workers can be productive from home. Employees prefer the flexibility. Companies save money on real estate. The technology for remote collaboration keeps improving. We are not going back to the old model, ever. What does this mean for office REITs? It means permanent vacancy. It means falling rents. It means properties worth a fraction of what they were valued at 5 years ago. Some office buildings in major cities have sold for 50 or 60% less than their previous valuations. Others cannot find buyers at any price. The office REITs are carrying these properties on their books at values that do not reflect reality. They are pretending that the buildings are worth what they paid for them. But the market knows better. Office REIT stock prices have collapsed because investors understand that the stated asset values are fiction. And the worst is yet to come. Many office leases signed before the pandemic are still in effect. When those leases expire over the next few years, tenants will downsize or leave entirely. Vacancy rates will spike further, rents will fall further, and office REIT values will crater. Retail is another sector facing structural decline. E-commerce has been taking market share from physical retail for 20 years, and the trend is accelerating. The pandemic pushed even more shopping online. Consumers have learned that they can buy almost anything from their phones and have it delivered the next day. Regional malls are dying. Department stores are closing. Even strip centers are struggling as anchor tenants fail and foot traffic declines. The retail apocalypse that people have been predicting for years is finally arriving in full force. Retail REITs that own Class B and C malls are essentially worthless. The properties will never recover. They will be demolished or converted to other uses. The equity value is gone. Even grocery-anchored retail, which was supposed to be resistant to e-commerce, is under pressure. Online grocery delivery has grown dramatically. Dark stores and micro-fulfillment centers are replacing traditional grocery locations. The assumption that people would always shop for groceries in person is proving false. The third force is the banking crisis that is quietly unfolding. Regional banks are major lenders to commercial real estate. They hold hundreds of billions of dollars in loans to office buildings, retail centers, apartment complexes, and other properties. Many of these loans are going bad. The properties are worth less than the loan balances. The borrowers cannot refinance because no one will lend at current property values. The banks are facing massive losses that they have not yet recognized. We saw a preview of this in early 2023 when Silicon Valley Bank and Signature Bank and First Republic failed. Commercial real estate exposure was a major factor in those failures. But those were just the beginning. There are hundreds of regional banks with significant commercial real estate exposure. They are carrying loans at values that assume the properties are worth what they were worth in 2019. They are not. When the banks are forced to recognize reality, they will have to raise capital or fail. This banking stress will feed back into the REIT market in multiple ways. Banks will tighten lending standards, making it harder for REITs to refinance. Banks will foreclose on troubled properties, adding supply to already oversupplied markets. Bank failures will create contagion effects that spread fear throughout the financial system. The fourth force is the dividend sustainability crisis. REIT dividends are not as safe as investors believe. Many REITs are paying out more than they can sustain. They are borrowing to pay dividends. They are selling properties to fund distributions. They are using accounting tricks to make their payouts look sustainable when they are not. When a REIT cuts its dividend, the stock price typically crashes. Investors who bought for income sell in a panic. The selling pressure forces prices down further. Other investors see the decline and sell too. It becomes a self-reinforcing spiral. I expect dividend cuts across the REIT sector in the coming quarters, not just in troubled sectors like office and retail. Even apartment REITs and industrial REITs will face pressure as refinancing costs eat into cash flow. When these cuts are announced, prices will plummet. Now let me get specific about which types of REITs are most vulnerable and why you need to get out immediately. Office REITs are the most dangerous sector. I've already explained the structural forces destroying demand for office space. But let me be even more specific about what is happening. The largest office REITs own billions of dollars of properties in major cities like New York, San Francisco, Los Angeles, Chicago, and Boston. These properties were valued based on assumptions that no longer hold. They assumed office workers would return to the office full-time. They assumed tenants would renew their leases at similar terms. They assumed property values would recover. None of this is happening. Office utilization rates in major cities remain 40 to 50% below pre-pandemic levels. I have looked at the data from building access systems, from transit ridership, from cell phone location tracking. All of it tells the same story. Workers are not coming back to the office 5 days a week. They may never come back 5 days a week. Tenants are not renewing leases at the same square footage. They are downsizing dramatically or leaving entirely. When a lease expires, the tenant typically takes 30 to 50% less space. Some tenants do not renew at all. They have discovered they can operate without a physical office, or they can use flexible workspace on an as-needed basis. Sublease space is flooding the market as companies try to offload space they no longer need. This is space that was leased years ago, often at below market rates, that companies cannot use and cannot afford to keep. The sublease market competes with direct leasing and pushes overall rents down. The vacancy rates in some markets are approaching 30%. That is depression-level vacancy. San Francisco is particularly troubled with vacancy rates over 30% in some submarkets. But the problem exists in every major office market. And it is getting worse, not better, as leases signed before the pandemic continue to expire. I have spoken with commercial real estate brokers who tell me that large blocks of space cannot find tenants at any price. Landlords are offering 6 months or even a year of free rent just to get tenants in the door. They are paying for tenant improvements that they used to make tenants pay for. The concessions are extraordinary, and they are not working. Property values have collapsed. Buildings that traded at $500 per square foot are now selling at $200 per square foot or less. Some buildings have sold at prices below their construction costs. Buyers are betting that the land value will eventually justify the purchase, but the building itself is essentially worthless. Let me give you some specific examples that illustrate the carnage. In San Francisco, a building that sold for $300 million in 2019 recently sold for $80 million. That is a 73% decline. In Los Angeles, a major office tower sold for $120 million after being valued at $250 million just a few years earlier. In New York, lenders are foreclosing on office buildings and selling them at auction for fractions of their original values. These are not isolated incidents. They are the new normal for office real estate. And the worst is yet to come, because many of the properties that need to sell have not yet traded. The owners are holding on, hoping for recovery, delaying the recognition of losses, but they cannot delay forever. The office REITs have not marked down their properties to reflect these values. They are using appraisals based on optimistic assumptions about occupancy and rents. The stated net asset values are fantasy. The true values are far lower. When these REITs refinance their debt, the lenders will require new appraisals. Those appraisals will reflect reality. The REITs will discover that they are technically insolvent with debt exceeding property values. They will have to raise equity at distressed prices, diluting existing shareholders massively. Or they will default. I have seen this movie before. In the early 1990s, the office market crashed after a building boom created massive oversupply. REITs that had borrowed heavily went bankrupt. Shareholders were wiped out. The recovery took nearly a decade. The current situation is worse because the oversupply is permanent, not cyclical. In the 1990s, the market eventually absorbed the excess space as the economy grew and companies expanded. This time, companies are shrinking their space requirements even as the economy grows. The demand is not coming back. Some office buildings will simply be handed back to lenders. The owners will walk away because the properties are worth less than the mortgages. This is already happening. It will accelerate. The question is not whether office REITs will crash. The question is how severe the crash will be. I believe many office REITs will see their equity values fall by 50% or more from current levels. Some will go bankrupt. The dividends will be eliminated. If you own any office REITs, sell them immediately. I do not care what the dividend yield is. I do not care what the analyst ratings say. These REITs are heading for disaster. The only question is timing, and the timing could be this quarter.
Regional mall REITs are equally dangerous. The enclosed shopping mall is a dying concept. Anchor tenants like Sears, JCPenney, and Macy's have closed hundreds of stores.
When an anchor closes, it triggers co-tenancy clauses that allow other tenants to reduce rent or leave. The mall enters a death spiral. Let me explain how these death spirals work because they are accelerating and devastating equity values. A typical regional mall depends on department store anchors to draw traffic. Shoppers come for the anchor and then visit the smaller tenants in the rest of the mall. The anchors typically pay very low rent, sometimes nothing at all, because their traffic generating value justifies the subsidy. When an anchor closes, foot traffic drops immediately. The remaining tenants see their sales decline. They invoke co-tenancy clauses in their leases that allow them to reduce rent or terminate their leases entirely. More tenants leave. Traffic drops further. More tenants leave. The spiral continues until the mall is essentially empty. This is not theoretical. I have watched it happen at dozens of malls across America. Malls that were thriving 10 years ago are now boarded up and awaiting demolition. The equity in those properties is worthless. Class B and C malls are already dead. They just have not been buried yet. The owners are trying to redevelop them into mixed-use properties, but most of these redevelopment plans are fantasies. The locations that made sense for malls do not necessarily make sense for apartments or office space or industrial use. Mall locations were chosen for highway accessibility and large parking fields. Those characteristics work against conversion to other uses. Apartments need walkability and amenities. Offices need transit access. Industrial uses need truck access and low costs. Most mall sites fail these tests. The costs of redevelopment are staggering. You have to demolish existing structures, remediate environmental issues, install new infrastructure, construct new buildings, and navigate complex zoning processes. By the time you are done, the total investment often exceeds what you could buy or build elsewhere. Even Class A malls, the best of the best, are struggling. They have maintained occupancy by offering massive rent concessions, but rent concessions destroy the cash flow that supports dividends. And as leases roll over at lower rates, the impact on earnings is severe. I have looked at the lease rollover schedules for the major mall REITs. The leases signed during the good times are expiring and being replaced with leases at significantly lower rates. Net operating income is declining even at malls that appear to be fully occupied. The revenue compression is relentless. The tenants that remain in malls are demanding shorter lease terms. They do not want to commit to 10-year leases in a format that may not exist in 10 years. This creates additional uncertainty for mall owners and further depresses property values. E-commerce continues to take share from physical retail. Every year, a larger percentage of retail sales moves online. The pandemic accelerated this shift, and there is no going back. Younger consumers have grown up shopping on their phones. They do not have the nostalgic attachment to malls that older generations have.
The regional mall REITs are trading at steep discounts to their stated net asset values.
But those discounts are not big enough. The stated values are based on appraisals that use cap rates and rent assumptions from a bygone era. The true values are even lower. I expect more mall REIT bankruptcies in the coming years. The equity will be wiped out. The debt holders will take over the properties and try to salvage what they can. This has already happened to several mall REITs, and more will follow. The pattern of mall REIT bankruptcies is instructive. First, the company stops paying dividends. Then it tries to restructure its debt. Then it defaults. Then it files for bankruptcy. Then the equity is canceled, and the bondholders take over. The process takes a few years, but the outcome is always the same. Shareholders get nothing. If you own mall REITs, get out now. Do not wait for the bankruptcy filing. Sell while you still can get something for your shares.
Healthcare REITs face a different set of challenges, but they are equally concerning. The pandemic exposed the fragility of the senior housing and skilled nursing business models.
Occupancy collapsed as families kept loved ones out of congregate care facilities. Labor costs exploded as workers demanded hazard pay and facilities competed for scarce staff. The pandemic is over, but the damage lingers. Occupancy has recovered somewhat, but remains below pre-pandemic levels. Many families who moved their loved ones out of facilities during the pandemic decided to keep them at home.
The experience of COVID deaths in nursing homes created lasting fear about congregate care.
Labor costs remain elevated. The healthcare workforce was traumatized by the pandemic. Many workers left the industry entirely. Those who remain demand higher wages and better working conditions. The labor shortage is structural, not temporary. Immigration restrictions limit the supply of workers. Domestic birth rates are low. The math simply does not work. And the demographic tailwind that was supposed to drive demand has been delayed as younger seniors choose to age in place rather than move to facilities. Baby boomers are healthier and more independent than previous generations. They have technology that allows them to monitor their health and stay connected. They have home health care options that did not exist before. They are choosing to stay in their homes as long as possible. This means the wave of demand that healthcare REITs were counting on has not materialized. The facilities they built or acquired in anticipation of booming demand sit partially vacant. The economics that justify those acquisitions do not work at current occupancy levels. Many healthcare REITs own properties operated by tenants who are struggling to stay solvent. The operators cannot afford their rent payments. The REITs face a choice: reduce rents and see their income fall, or hold firm and watch their tenants go bankrupt. Neither option is good for shareholders. When an operator goes bankrupt, the REIT faces significant costs. They must find a new operator willing to take over the facility. They often have to make capital improvements to attract a new operator. They may face periods of vacancy during the transition. The value of the property is impaired. The skilled nursing sector is particularly troubled. Medicaid reimbursement rates have not kept pace with cost increases. State and federal budgets are under pressure. Politicians promise to protect healthcare spending, but the math does not work. Something has to give, and it is often Medicaid rates. Staffing mandates are increasing expenses. Regulators are requiring higher nurse-to-patient ratios and more training. These mandates increase costs without increasing revenue. Operators cannot pass these costs through to Medicaid patients. They absorb them, which destroys their margins. Many nursing homes are operating at losses. They remain open only because closing would strand patients and create political problems, but they cannot sustain losses indefinitely. When these facilities fail, the real estate is often worthless because it cannot be easily converted to other uses. Nursing homes are purpose-built facilities with specialized infrastructure. Converting them to apartments or other uses requires massive investment. The locations are often unsuitable for other uses. When a nursing home fails, the building often sits vacant for years before being demolished.
Healthcare REITs also face interest rate pressure like all REITs. They borrowed heavily during the low-rate era to acquire facilities. Now they must refinance at much higher rates. The math does not work.
Something has to give.
The combination of operating pressure from struggling tenants and financial pressure from refinancing at higher rates creates a vice that is squeezing healthcare REITs from both sides.
Cash flows declining while debt service costs are rising. Dividend cuts are inevitable for many healthcare REITs. Mortgage REITs are another disaster waiting to happen. And I covered these extensively in my previous warning about high-yield investments. They use extreme leverage to invest in mortgage-backed securities. When interest rates move against them, the leverage amplifies losses to devastating levels. We saw this in 2022 when mortgage REITs lost 50% or more of their value. Many investors assumed the worst was over. They were wrong. The conditions that caused those losses have not changed. Interest rate volatility remains elevated. Credit spreads could widen at any moment. The leverage remains extreme. Mortgage REITs are not really real estate investments at all. They are leveraged bets on interest rate spreads. When spreads move against them, equity gets wiped out. The high dividend yields that attract investors are often unsustainable. They are funded by depleting book value, not by genuine earnings.
If you own mortgage REITs, sell them now. Do not wait for the next leg down. Protect your capital while you still can.
Even the sectors that seem healthy face significant risks in the coming quarters. Apartment REITs benefited enormously from the pandemic. Work from home allowed people to move away from expensive cities. Household formation increased as people wanted more space. Rents spiked in many markets.
The Sun Belt saw explosive growth as people fled high-tax, high-cost states for Florida, Texas, Arizona, and Georgia. Apartment REITs that own properties in these growth markets saw rents increase by 30, 40, even 50% in just a few years. Their cash flows soared. Their stock prices reached all-time highs. Investors thought the good times would continue forever. But the apartment boom is ending. New supply is flooding the market. Developers who started projects during the pandemic are now delivering units into a softening market. The construction pipeline is enormous. Hundreds of thousands of new apartment units are coming online over the next 12 months. This supply wave is concentrated in exactly the markets that saw the biggest rent increases. Austin has more apartments under construction than almost any city in America relative to its existing stock.
Phoenix, Nashville, Atlanta, Denver, Charlotte, Raleigh. These markets all have massive supply pipelines.
When supply exceeds demand, rents fall. We are already seeing this in the data. Effective rents in Austin have fallen by 10 to 15% from their peaks. Phoenix is seeing similar declines.
The concessions are returning free months' rent, reduced deposits, landlords desperate to fill units. The apartment REITs that expanded aggressively during the boom will face pressure. They paid premium prices for properties that are now generating less income. They acquired at cap rates of 4% or lower, assuming continued rent growth would justify those prices. Now rents are falling, and those acquisitions look very different.
Many apartment REITs borrowed to fund acquisitions that no longer make sense at current cap rates. They levered up during the boom, assuming that strong rent growth would allow them to service the debt easily.
Now they face refinancing at higher rates while their income is declining. The math is brutal. Dividend cuts are likely as refinancing costs rise and rents fall. The apartment REITs that seemed bulletproof during the pandemic will reveal their vulnerabilities. The investors who bought for stable income will discover that apartment income is not as stable as they believed. Some markets are in better shape than others. New York and California have limited supply due to construction restrictions and rent control.
But even these markets face challenges as remote work allows tenants to leave for lower-cost areas.
Industrial REITs, which own warehouses and distribution centers, seemed bulletproof during the pandemic. E-commerce was booming. Companies were stockpiling inventory. Demand for warehouse space seemed insatiable. Vacancy rates in industrial markets fell to historic lows. Rents doubled or tripled in some markets. Industrial REITs became the darlings of the REIT world. They traded at premium valuations because investors believed the growth would continue indefinitely. E-commerce was still a small percentage of total retail sales. As it continued to grow, industrial demand would grow with it. The story seemed bulletproof. But the industrial boom is moderating. E-commerce growth has slowed from the torrid pace of the pandemic years. Online retail sales are still growing, but at a much slower rate. The explosive growth phase is over.
Companies have reduced inventory levels after building too much during the supply chain crisis. Remember when companies were stockpiling everything they could get their hands on?
They were terrified of running out of inventory. Now they have too much. They are working down those inventories rather than adding to them. Some tenants are actually giving back space they no longer need.
Retailers that leased massive distribution centers during the pandemic are finding they can operate with less.
They are subleasing excess space or not renewing when leases expire. The sublease market in industrial real estate is growing rapidly. This is space that was leased at premium rates during the boom that tenants no longer need. It competes with direct leasing and pushes overall rents down. Landlords who thought they had locked in high rents for years are discovering that their tenants want out. Industrial REIT valuations soared during the pandemic. They priced in years of continued growth that may not materialize. As the reality becomes clear, prices will adjust downward. The cap rate compression that occurred in industrial real estate was extreme. Properties that traded at 6% cap rates historically were trading at 3 or 4%. Investors were paying premium prices based on growth assumptions that are now being questioned. When cap rates expand back toward historical norms, industrial property values will fall substantially. A property valued at $300 million at a 4% cap rate is worth only $200 million at a 6% cap rate. That is a 33% decline with no change in the underlying income. Data center REITs have been darlings of the artificial intelligence boom. The need for computing power to train and run AI models has driven demand for data center space. Valuations have soared. Some data center REITs have doubled or tripled in value over the past few years. The AI story is compelling. These models require enormous amounts of computing power. The tech giants are in an arms race to build AI capabilities. They need data centers to house the servers that run these models. Demand seems unlimited. But data center REITs face risks that investors may not appreciate. Power constraints are limiting growth in many markets. Data centers consume massive amounts of electricity. Some markets simply cannot provide enough power to support additional data center construction. Utilities are limiting new connections. Projects are being delayed or canceled. Construction costs have increased dramatically. Building data centers requires specialized infrastructure, massive electrical systems, sophisticated cooling, redundant systems. The costs have increased by 50% or more since the pandemic began. Projects that look profitable at old cost estimates no longer work. Competition is intensifying as tech giants build their own facilities. Amazon, Microsoft, Google, Meta, these companies are building proprietary data centers rather than leasing from REITs. They have the scale and the expertise to build and operate their own facilities. This reduces demand for third-party data center space, and the AI boom could slow if the technology disappoints or if economic conditions deteriorate. AI investments are discretionary for many companies. If the economy weakens,
they will delay or cancel AI projects. The demand that data center REITs are counting on could evaporate quickly.
The valuations on data center REITs assume continued explosive growth. If that growth falters, the stocks will fall hard, the premium multiples will compress to normal levels, the losses will be substantial. Now let me explain why this crash could start this quarter specifically. The timing is not random. Several catalysts are converging. First, the wave of debt maturities is hitting now. REITs that borrowed in 2018 and 2019 with 5-year terms are facing refinancing. REITs that borrowed in 2020 and 2021 with 3-year terms are also coming due. The amount of debt that needs to be refinanced in the next 6 months is enormous. I have analyzed the debt maturity schedules of the major REITs. What I see is alarming. Billions of dollars in debt will need to be refinanced in the coming months. The terms available today are dramatically worse than the terms of the original loans. Higher rates, tighter covenants, lower loan-to-value ratios. Many REITs will not be able to refinance on any terms. When a REIT cannot refinance, it must raise equity, sell properties, or default. All 3 options are painful for shareholders. Equity raises dilute existing shareholders at low prices. Property sales in a distressed market realize losses. Defaults wipe out equity entirely. Second, year-end financial reporting will force REITs to update their property valuations. Many REITs have been delaying recognition of impairments, hoping that conditions would improve. Auditors are becoming less patient. The annual reports due in the coming months will likely include significant write-downs. The accounting rules require REITs to test for impairment when circumstances suggest that carrying values may exceed fair values. The circumstances I have described, falling rents, rising vacancies, declining transaction values, clearly suggest that many properties are impaired. Auditors who signed off on optimistic valuations in previous years face liability if they continue to do so. They will push back on management estimates. They will demand evidence supporting carrying values. When that evidence is not available, impairments will be required. When REITs announce large impairments, stock prices will fall. Investors will realize that the stated book values they relied on were fiction. Confidence in REIT valuations will collapse across the sector. Third, bank regulators are increasing pressure on lenders to recognize problem loans. The extend and pretend approach that has allowed troubled properties to avoid foreclosure is ending. Banks will have to choose between foreclosing or taking write-downs. Either choice will have ripple effects through the REIT market. The Federal Reserve and other regulators learned from the 2008 crisis that delayed recognition of losses makes problems worse. They are pushing banks to be realistic about commercial real estate exposure. Banks that resist will face regulatory consequences. When banks foreclose on properties, those properties enter the market and must be sold. This adds supply to already oversupplied markets. It establishes transaction values that contradict stated appraisals. It forces other owners to recognize that their properties are worth less than they claimed. Fourth, dividend announcements in the coming weeks will reveal which REITs can sustain their payouts and which cannot. REITs that cut dividends will see their stock prices crash. The fear of dividend cuts will spread to other REITs, creating selling pressure across the sector. Many REITs have been paying dividends that exceed their funds from operations. They have been dipping into reserves, selling properties, or borrowing to maintain dividends. This is not sustainable. Eventually, they must cut. The dividend cuts will come in waves. First, the most troubled REITs will cut. Then investors will look at other REITs and ask, who is next? The speculation will create selling pressure. More cuts will follow. The cycle will continue until dividends are reset to sustainable levels. Fifth, the economic outlook is deteriorating. Consumer spending is slowing. Business investment is weakening. The labor market is softening. A recession may have already begun. Recessions are terrible for real estate values and REIT prices. When the economy weakens, tenants fail, occupancies fall, rents decline, property values drop. The operating challenges that REITs face become more severe. The financial challenges from refinancing become more acute because lenders are less willing to extend credit during recessions. When these catalysts converge, the selling pressure will be intense. Investors who have been holding on, hoping for recovery, will finally capitulate. Forced selling from funds facing redemptions will add to the pressure. The decline will feed on itself as falling prices trigger more selling. I have seen this pattern before. I saw it in 2008 when the commercial real estate market collapsed. I saw it in the early 1990s when over-leveraged REITs went bankrupt. The current setup has echoes of both periods. Let me tell you what I think you should do. First, sell your REIT holdings now. Do not wait for the crash to confirm my warning. By then it will be too late. The losses will have already occurred. Sell while you still can get reasonable prices. I know this is difficult. Many investors have held REITs for years. They like the income. They believe in real estate as an asset class. They think the dividends are safe, but the dividends are not safe. The income you are collecting will not compensate for the capital you are about to lose. Let me be specific about what you should sell. Sell all of your office REITs immediately. These are the most vulnerable and will suffer the largest losses. Names like Boston Properties, Vornado, SL Green, Paramount Group, these are all in serious danger. The office market is in structural decline that will last for years. Sell all of your mall REITs. Regional mall owners like Maxaric and others are facing extinction. The enclosed shopping mall is a dying format. The equity values will continue to erode until they reach zero. Sell your healthcare REITs, especially those focused on skilled nursing and senior housing. The operating challenges are severe, and the interest rate pressure will force dividend cuts and equity dilution. Sell your mortgage REITs. These are leveraged bets on interest rate spreads, not real estate investments. When conditions turn against them, equity gets destroyed quickly. The high yields are illusory. Be very cautious with your apartment REITs, especially those with exposure to Sunbelt markets where supply is flooding in. Consider selling or at least reducing your positions. The risks are significant. Be cautious with your industrial REITs. The valuations assume continued growth that may not materialize. Consider reducing exposure. Be cautious with your data center REITs. Despite the AI hype, the valuations are extreme and many risks are not priced in. Second, if you insist on owning REITs, be extremely selective. Not all REITs are equally vulnerable. Cell tower REITs like American Tower and Crown Castle have contractual revenue streams and limited exposure to the forces I have described. Their tenants are wireless carriers who must pay to maintain their networks. The leases are long-term with built-in escalators. These REITs are not immune to interest rate pressure, but they are more defensive than most. Self-storage REITs have proven resilient through multiple cycles. Demand for storage is relatively stable. The tenants are sticky because moving possessions is a hassle. The properties are cheap to build and operate, which limits overbuilding. Self-storage REITs are not exciting, but they are less likely to blow up. Net lease REITs with long-term triple net leases to creditworthy tenants may hold up better than average. These are REITs that own single-tenant properties leased to companies like Walgreens, Dollar General, or major restaurant chains. The tenants pay all the operating expenses, taxes, and insurance. The REIT just collects rent. The key to net lease REITs is the credit quality of the tenants. A triple net lease to a bankrupt tenant is worthless. Make sure the REIT owns properties leased to strong tenants with long remaining lease terms. But even these relatively safer REITs face interest rate pressure and refinancing risk. They are not immune. I would underweight them significantly, not overweight them. Third, avoid the temptation to buy the dip. As REIT prices fall, many investors will think they see bargains. They will see dividend yields of 8 or 10 or 12% and convince themselves they are getting great deals. They will be wrong. A high dividend yield means the market expects the dividend to be cut. A low stock price relative to stated book value means the market does not believe the stated book value. The market is usually right about these things. I have seen investors try to catch falling knives in REIT crashes before. They see prices down 50% and think it cannot go lower. It can. It does. Prices can fall another 50% from already depressed levels. Wait until the bad news is fully priced in. Wait until dividend cuts have been announced. Wait until property values have been written down to realistic levels. Wait until the weakest REITs have failed and been removed from the market. Only then should you consider buying. This process will take years, not months. The real estate market moves slowly. Properties do not trade as quickly or transparently as stocks. It takes time for true values to become apparent. Be patient. The best time to buy REITs will be when everyone hates them, when the financial media is writing obituaries for the REIT industry, when investors have given up and sold everything, when yields are in the double digits because prices have crashed and no one is buying. That is when generational opportunities emerge. We are not there yet. We are in the early stages of the crash, not the capitulation phase. There will be time to buy later. Do not rush. Fourth, consider the alternatives. If you need income, there are safer ways to generate it. Treasury bonds now yield 5% with no risk of loss. Investment-grade corporate bonds yield 6%. High-quality dividend stocks from companies with long histories of dividend growth offer both income and appreciation potential. These alternatives will not give you the 8 or 10% yields that some REITs offer, but those high yields come with high risk. As I have explained, many of those dividends will be cut. The high yields are an illusion that will evaporate when reality intrudes. I would rather earn 5% safely than reach for 10% and lose 30% of my principal. The math is clear. Safety beats yield when yield comes with capital loss. If you are retired and need income, Treasury bonds are your friend right now. They pay meaningful yields for the first time in years. They are backed by the full faith and credit of the United States government. They will not cut their interest payments. They will not lose value to default. If you want equity exposure with income, consider Dividend Aristocrats. These are companies that have raised their dividends for at least 25 consecutive years. Companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, PepsiCo, they have proven they can maintain and grow dividends through recessions and market crashes. The current yield on these Dividend Aristocrats may only be 3 or 4%, but the dividends grow every year, and the companies appreciate in value over time. The total return is competitive with REITs without the same risks. Fifth, watch the signals I have described. Monitor the debt refinancing announcements. Watch for dividend cut announcements. Track the banking sector for signs of stress related to commercial real estate. Follow the major office and retail markets for vacancy rate data. When you see these signals flashing red, it will confirm that the crash is underway. But do not wait for confirmation to act. Act now, while prices are still relatively stable. The time to sell is before the crash, not during it. Let me address some objections I know some of you will have. Some will say that I am being too pessimistic. Real estate always recovers eventually. The economy is still growing. Interest rates may fall again. I am not being pessimistic. I am being realistic. Yes, real estate eventually recovers from most downturns, but eventually can be a very long time. It took over a decade for commercial real estate values to recover from the 2008 crash. Some properties never recovered. The investors who bought those properties lost everything. And some of what I am describing is not cyclical. Office demand is not coming back to pre-pandemic levels. Regional malls are not going to experience a renaissance. These are structural changes, not temporary setbacks. Waiting for recovery in these sectors is waiting for something that will never happen. Interest rates may fall somewhat from current levels, but they are unlikely to return to the 0% rates of the pandemic era. That was an extraordinary policy response to an extraordinary crisis. The Federal Reserve has made clear that rates will remain higher for longer. The new normal is not 0% interest rates. Some will say that REITs are trading at discounts to net asset value, so the bad news is already priced in. The discounts are not large enough. The stated net asset values are based on appraisals that use stale assumptions. When properties actually trade, they sell for far less than appraised values. The true discounts to true values are much smaller than they appear. I have looked at actual transaction data. Properties are selling at 20, 30, sometimes 50% below their most recent appraisals. The gap between appraised values and market values is enormous. The stated book values are fiction, and discounts to NAV can widen dramatically in a crisis. During 2008, some REITs traded at 50 or 60% discounts to stated NAV. The current discounts of 10 or 20% are nothing compared to what is possible. There is much more downside ahead. Some will say that professional investors are still buying REITs, so they must know something I do not. Professional investors are often wrong. They were wrong about mortgage-backed securities in 2007. They were wrong about dot-com stocks in 1999. They are human beings, subject to the same cognitive biases as everyone else. They chase yield just like retail investors. They believe stories that sound good. They follow the crowd. Many professional investors are trapped in REITs because of benchmark requirements or mandate restrictions. They cannot sell even if they want to. Their continued ownership does not reflect conviction. It reflects constraints. The fact that other investors are buying is not a reason for you to buy. it may be a reason to sell. When smart money is trapped and dumb money is still buying, that is often the setup for a crash. Some will say they need the income and cannot afford to give up their REIT dividends. You cannot afford to lose 30 or 40% of your principal either. Income does not help if your capital is being destroyed. You can generate income in other ways that do not involve taking this level of risk. I understand the appeal of REIT dividends. I understand that many investors, especially retirees, depend on that income. But depending on income that may not be sustainable is dangerous. You need to find alternatives before the dividends disappear. The dividends you are collecting today may not exist in a year. When they are cut, your income will disappear anyway. Better to transition to sustainable income sources now on your own terms than to be forced to do so later when your capital has been decimated. Let me close by putting this warning in perspective. I have made many predictions over my investing career. Some have been right, some have been wrong. I do not have a crystal ball. I cannot tell you exactly when the REIT crash will happen or exactly how severe it will be. But I can tell you that the conditions for a crash are in place. The vulnerabilities are real. The catalysts are converging. The risks are asymmetric, meaning the downside is much larger than the upside. When I see conditions like this, I get out of the way. I do not try to squeeze out a few more quarters of income. I do not hope that things will get better. I protect my capital and wait for safer opportunities. That is what I am urging you to do. Protect your capital, sell your vulnerable REIT positions, accept lower but safer income from other sources, and wait. The crash may start this quarter. It may start next quarter. But it is coming. The math guarantees it. And when it arrives, you want to be watching from the sidelines, not trapped in positions that are collapsing. I have been investing for over 70 years. I have seen many market cycles. I have learned that the time to sell is when things still look okay, not when the crisis is obvious to everyone. By then, it is too late. The REIT market still looks okay to many investors. The dividends are still being paid. The prices are down but not crashed. There is still time to get out. That time is now. This quarter, before the refinancing wave hits, before the dividend cuts are announced, before the banking stress spreads, before the crash that I believe is coming arrives. Do not say you were not warned. I am warning you now. The REIT crash could start this quarter. Protect yourself before it is too late. Sell your office REITs. Sell your mall REITs. Sell your healthcare REITs. Sell your mortgage REITs. Be very careful with your apartment REITs and industrial REITs and data center REITs. They are not as safe as they seem. Move to safety. Accept lower yields. Preserve your capital. And when the crash comes, and it will come, you will be grateful that you listened. This is my warning. This is my advice. This is what 70 years of experience has taught me about recognizing crashes before they happen. The time to act is now. Do not wait. The REIT crash that could start this quarter is not a possibility to dismiss. It is a probability to prepare for. Your financial future depends on the actions you take today. Choose wisely, protect yourself, and do not look back when the crash confirms everything I have told you. You have been warned.